The Fibonacci retracement is one of the most widely used tools in technical analysis. It helps traders identify potential support and resistance levels, map out pullbacks, and structure entries and exits based on natural price behavior. And in this video, part of our Best Trading Indicators Explained Step-by-Step series, we're going to walk through exactly how to set up the Fibonacci retracement tool, how it works, and how to use it with clarity and confidence, directly on your chart using real market examples. In the next sections, you'll learn exactly how to apply Fibonacci retracement levels to your charts, but always remember, these are guidelines, not guarantees. Before we start drawing anything, there's one essential concept you need to understand: market structure. Fibonacci only makes sense when applied in the context of a trend. You need to recognize whether the market is making higher highs and higher lows, an uptrend, or lower highs and lower lows, a downtrend. If you're still unsure about that, we highly recommend going back to the market structure video from this course before continuing. Now let's set up the Fibonacci tool properly. In TradingView, open the left toolbar. Click the arrow next to GAN and Fibonacci tools and select Fib retracement. To analyze a bullish move, connect the low to the high with 100% at the bottom and 0% at the top. To analyze a bearish move, reverse the process. Connect the high to the low with 100% at the top and 0% at the bottom. Now, let's adjust the Fibonacci tool to make it more effective for our strategy. By default, the Fibonacci retracement tool on TradingView includes several levels that we at ComLucro consider unnecessary. In fact, it also comes preloaded with extension levels like 1.618 and beyond, which are not intended to be used with the retracement tool. These extensions should be applied using the proper Fibonacci extension tool, not mixed in with retracement setups. To access the settings and clean up your Fibonacci tool, follow these steps. Once you've drawn the Fibonacci on the chart, simply double-click on the lines or shaded area. This will immediately open the configuration panel. First, remove the levels beyond 1. Uncheck them and you'll see them disappear. Next, eliminate the background color by unchecking it. Then, uncheck price to remove the numerical price labels and reduce visual clutter on the chart. Next, let's convert the values to percentages. Open the drop-down menu and select %. You'll now see the Fibonacci levels displayed as percentages. To move these percentages to the right side of the tool, go to the Labels option, click the drop-down menu and select Right. The Fibonacci levels will now appear on the right-hand side. To improve readability, align the percentage labels directly beside each Fibonacci line. In the Labels option, select Middle from the drop-down menu and the percentages will shift next to each line. To make the percentages even more visible, adjust the font size by selecting 20 from the drop-down menu. You'll notice that the numbers are now larger and easier to read. Similarly, to make the Fibonacci lines more prominent, click Level Line, choose the thickest line option, and you'll see the lines become thicker and more visible. Next, let's adjust the colors of the Fibonacci lines based on their importance. We personally do not use the 23.6% and 78.6% levels, so feel free to remove them if they're not part of your strategy. The 0% and 100% levels should be set to red. The 0% level marks where a breakout and continuation of the trend occur, while the 100% level indicates a possible trend reversal. Set the 38.2% level to light green as it represents a shallow pullback. Then change the 50% level to yellow. Even though it's not technically a Fibonacci ratio, it's still an important psychological level that traders pay close attention to. Finally, set the 61.8% level to orange. This is the most critical Fibonacci level, often signaling strong reactions or potential reversals in the market. Now, let's go over the rest of the settings in the Style tab, just so you understand exactly what each option does and how we recommend setting it up. Right below the levels, you'll see an option called Use One Color. We keep this unchecked because we like to assign different colors to each Fibonacci level individually. That helps visually separate each zone and makes the chart easier to read. Next, you'll see Background. We already turned that off earlier. Leaving it unchecked removes that shaded area between the levels, which keeps your chart clean and focused. Then there's an option called Reverse. This flips the Fibonacci levels upside down. We leave this off as well, because when you draw the tool correctly, from low to high in an uptrend or high to low in a downtrend, you won't need to reverse anything. Let's move on. We've already talked about prices, which we also leave unchecked. We don't need the price labels cluttering the chart. Just the percentages are enough. Below that, you'll find the levels setting. Make sure it's set to %, not values. This is what turns the raw values into those clean percentage labels like 38.2%, 50%, 61.8%, and so on. Then we have a few layout controls. Labels, we set this to right and middle so that the percentage shows up aligned in the middle of each line and on the right-hand side of the tool. Text, leave this as center and middle, which centers the label perfectly next to each level. Now for font size, we recommend setting it to 20. It's big enough to read easily, even if you zoom out on the chart. Finally, you'll see a checkbox at the bottom that says Fib levels based on log scale. You can leave this unchecked as well. Unless you're analyzing assets over huge price ranges, this option won't make a meaningful difference in day-to-day trading. And that's it. These are now the optimal settings for your Fibonacci tool. Now let's switch to the Coordinates tab. This is where you can manually adjust the exact start and end points of your Fibonacci retracement, both in terms of price and bar position on the chart. You'll see two entries. The first one represents the initial anchor point of the tool, either the low or the high, depending on the direction you drew it. The second one represents the final anchor point, where the retracement ends. You can type in specific values if you want to be extremely precise, for example, matching exact highs and lows of candles, or if you're replicating the same Fibonacci setup across multiple charts. We normally draw the tool directly with the mouse, but this tab is useful when you want to lock in precise coordinates or make fine adjustments after drawing. Just remember, changing values here will instantly update the position of your Fibonacci levels on the chart. Finally, we have the Visibility tab. This section lets you control which time frames your Fibonacci retracement will appear on. You'll see a list with ticks, seconds, minutes, hours, days, weeks, and months. Each row defines a visibility range, for example, from 1 to 59 minutes or 1 to 24 hours. If a box is checked, the Fibonacci tool will be visible on that specific time frame. If it's unchecked, it will be hidden whenever that time frame is active on the chart. At the bottom, there's a section called Ranges, which allows for more advanced visibility rules. But to be honest, in most cases, you won't need to touch this. And that's it. Once you've gone through all these settings, your Fibonacci retracement tool will be fully customized, clean, and aligned with the strategy we use here at ComLucro. Now let's talk about who Fibonacci was and why his work is so important in various fields, including trading. Leonardo Fibonacci, an Italian mathematician from the 12th century, introduced the Fibonacci sequence to Western mathematics. The sequence starts with 0 and 1, and every number after that is the sum of the two numbers before it. This pattern can be found in nature, architecture, and as traders discovered, in financial markets too. But why does this sequence matter to traders? Because as the numbers grow larger, the ratio between them gets closer to 1.618, also known as the golden ratio. In trading, this number and its inverse, 0.618, are crucial for identifying areas where the market might change direction. These ratios aren't magic, but they help us recognize where many traders are likely to react, making it easier to predict potential price movements. When applied to financial markets, Fibonacci ratios help traders identify potential areas of support and resistance. The key retracement levels, 38.2%, 50%, and 61.8%, are used to predict how much of a previous move the market might pull back before resuming its trend. These levels are calculated based on divisions of the Fibonacci sequence. For example, 61.8% comes from dividing one number in the sequence by the next, such as 89 divided by 144. Similarly, 38.2% comes from dividing a number by the 1-2 places ahead, like 55 divided by 144. Now, in addition to retracement levels, we also use Fibonacci extensions to project price targets in trending markets, but we'll cover those in another video. Now, this is crucial, and it needs to be clear. One of the biggest mistakes traders make with Fibonacci retracement is treating it like an automatic buy or sell signal. They see price near a level and jump in, without any context. That's not strategy, that's guessing. Fibonacci isn't a trigger, it's a framework, a way to organize the chart and identify possible reaction zones. But if you use it blindly, without price action or trend context, you're setting yourself up for failure. So let's clear this up. Yes, Fibonacci can be extremely useful, but it doesn't work because of some natural law. It works because so many traders believe in it and act on it. At ComLucro, we always say never use Fibonacci in isolation. Combine it with price structure, volume, and market context. Because at the end of the day, it's not Fibonacci that moves the market. It's the people behind the trades. Fibonacci shines in trending markets, when price moves impulsively and then pulls back in a controlled way. That's where these levels help define entries, stops, and targets. But in choppy sideways conditions, it loses power and can be misleading. The bottom line? Fibonacci is a great tool when used correctly, and that starts with knowing what it really is and what it's not. And that brings us to something we'll repeat in every video of this series, because truly understanding this one principle can change the way you trade. If you've already heard this message and it resonates with you, feel free to skip ahead. But we strongly encourage you to stick around and even replay it until you can repeat it by heart. This isn't just theory. It's the foundation of consistent, sustainable trading. Here's something every trader needs to hear, especially if you're just starting out. Indicators are not magical signals. They don't predict the future. They simply reflect what's already happened. They're tools, valuable ones, but still just tools. They help you read context, not control outcomes. The real problem begins when traders expect certainty. When they treat indicators as if they guarantee success, that mindset leads to frustration, disappointment, and an endless cycle of jumping from one strategy to another. To really understand why this happens and how to avoid it, let me share a powerful idea from Mark Douglas, one of the most respected voices in trading psychology. He once explained that many traders believe their system or indicator told them what was about to happen. But in reality, the market moves because of the conviction, or lack of it, between buyers and sellers, not because of any mathematical formula. He pointed out that most of the reasons we hear in financial news are just stories made up to sound logical after the fact. And this illusion of certainty is what makes traders feel betrayed by their systems, thinking the methodology failed them, when in fact, no technical method can predict what will happen next on a trade-by-trade basis. As Mark said, technical systems only tell you what's likely to happen over a series of trades, never the next single one. And just to show how unpredictable the market really is, Mark once told a story about a trader he mentored. This trader was an excellent analyst, one of the best Mark had ever met, but he struggled to execute trades successfully. So Mark advised him to focus on analysis instead of trading other people's money. The man followed his advice and became an analyst for a major firm at the Chicago Board of Trade. One day, the firm's chairman, an old-school grain trader, sat down with him. The chairman was skeptical about technical analysis and wanted to see how it worked. As they watched the soybean market move within a range, the analyst confidently said that the current price would be the low of the day. The chairman laughed, picked up the phone, and ordered the sale of 10 million beans, 2,000 contracts, instantly driving the price down 10 cents. Then he turned to the analyst and said, "If I can do that, anyone can." And that's the lesson. Sometimes it takes just one player with enough size or conviction to completely destroy your perfect setup. So, the next time you find yourself waiting for that perfect signal, remember this: it only takes one player with enough power to make your setup irrelevant. That's why mindset matters. That's why context matters. And that's why indicators, no matter how popular, are tools, not crystal balls. And that wraps up our breakdown of this indicator. In every episode of this series, we'll keep reinforcing the same core message. Indicators don't give you an edge. How you use them does. To help you move from theory to practice, check the card above and the description below. We've linked real strategies that use this indicator in action. And if you want to keep growing, take a look at our full training programs. We've got smart money concepts to help you understand how the big players move the market. Technical analysis for day traders, focused on fast, practical decision-making. The Wyckoff method, to help you read price and volume with structure. And most importantly, our complete trading psychology playlist, Because no matter what strategy you use, mindset is what makes it work. Take the time to study. Focus on building real skill, not chasing shortcuts. Because at the end of the day, it's not the indicator that makes you profitable. It's how well you understand and use it. I hope you enjoyed today's video. If you found the content helpful or engaging, please give it a like, as this helps the video reach more traders like you. And don't forget to subscribe to the channel and turn on notifications so you never miss our latest insights on the markets and practical trading strategies. Sharing this video with your friends or on your social networks can make a big difference and helps our community become stronger. Now, if you want to go even deeper and get access to exclusive content, early video releases, and extra tools to support your journey, consider becoming a member of the ComLucro trader community right here on YouTube. It's a way to support our work and a smart investment in your own development. Thanks for watching, and I'll see you in the next video.